The latest economic indicators out of Turkey are certainly raising some significant questions. Today on the Deep Dive, our mission is really to cut through the noise, try and understand the red flags flashing in Turkey's economy. We're talking shrinking sectors, surging debt, and even a surprising twist in central bank reserves. We'll explore the industrial contraction, that mounting external debt, the central bank situation, and also a pretty fascinating shift we're seeing in the housing market. And just so you know, all our insights today are drawn directly from the July 21, 2025 weekly bulletin prepared by Economist Hakan Çalışkantürk. He's a real expert at dissecting these complex numbers. Okay, let's unpack this then, starting with manufacturing, because, well, it's such a core indicator of economic health, isn't it? The Turkey Manufacturing PMI, that's the Purchasing Managers Index, it dropped to 46.7 in June. Now, just a reminder for everyone tracking this, a PMI below 50, that firmly indicates contraction.
Right. And the context here is quite telling, actually. While the euro area did see a bit of a recovery, sort of nudging up to 49.5, Turkey is unfortunately among the countries contracting the hardest in Europe. We're seeing similar struggles in, say, Poland, with a PMI of 44.8 and Austria at 47.0. And this really stands in stark contrast to the growth we're observing elsewhere. Think Asia-Pacific countries like India soaring at 58.4, or even America, holding up at 52.9. So this tells us Turkey isn't just contracting, it's contracting relatively sharply compared to many global peers.
And drilling down even further, this isn't just an isolated issue in one or two places.
No, not at all. All 10 Turkish manufacturing sectors surveyed remained firmly below that 50-point threshold in June. It's indicating a pretty widespread slowdown.
Right, across the board.
Indeed. And if we look at what's happening sort of on the ground, the sectors hit hardest by this contraction are quite specific. We're talking textile products, apparel and leather products, and land and sea vehicles. Those seem to be feeling it the most.
But the data isn't always straightforward, is it? I mean, we're seeing some truly fascinating, almost contradictory nuances here. Take food products, for example. Exports seem to be recovering, yet the sector just saw its first employment loss in 7 months. What's going on there?
Yeah, that suggests domestic weakness might be overriding that international demand boost. It kind of hints at a dual speed thing happening even within one sector.
Interesting.
Or look at chemical, plastic, and rubber products. Input costs shot up sharply, but product prices haven't followed suit. That's a pretty clear sign of decreasing demand, just squeezing those profit margins. They can't pass the costs on.
So they're caught in the middle.
Exactly, and this really highlights how diverse the impacts are even within this overall contraction. In non-metallic mineral products, for instance, we saw a strong increase in new export orders, which sounds good, but it had quite a limited impact on accumulated work or employment. And crucially, like with chemicals, those input price increases weren't reflected in product prices. So even when external demand picks up, it seems domestic factors like pricing power or maybe internal capacity constraints are limiting the overall positive effect.
It's almost counterintuitive in some areas, like you said. The land and sea vehicles sector, sharp drops in accumulated work, production, new orders contracting, and yet employment increased. How does that work?
Well, that's often a classic sign of firms holding on to skilled labor, even during a downturn. They might be anticipating a relatively quick rebound, or maybe the costs of firing and then rehiring are just too high.
So maybe some underlying confidence despite the numbers, or just a lag?
It could be either or a bit of both. It definitely signals something complex happening there. But it's not all negative. On the brighter side, you have sectors like machinery and metal products. They actually showed a counter trend, strong increases in new orders and new export orders. So, some pockets of resilience are there amidst the overall downturn.
Okay, so a really mixed picture on the factory floor. Let's shift our gaze now to Turkey's financial pulse, because the numbers here tell an equally complex story, and in some ways maybe even more critical. We've seen what some are calling a reserve surprise at the central bank, but how does that really stack up against the surging national debt and the country's overall financial standing?
That's a great question, and definitely where things get interesting. So Turkey's central bank, the CBRT, it saw its gross reserves rise to $166.2 billion USD. And perhaps even more notably, its swap-excluded net reserves, the reserves without borrowed money, essentially increased to $41.0 billion USD as of July 11. On the face of it, that's a positive movement in the reserve position.
Okay, that sounds like good news, a strengthening buffer. But hang on, are there any caveats here? What about those FX-protected deposits, the KKM scheme, and overall foreign currency holdings? Does that paint a different picture?
Absolutely. The nuance is really important here. You're right to ask. While the reserves improved, those KKM stocks actually decreased by 2.4% in the same week, down to 522 billion Turkish lira. And at the same time, foreign currency deposits held by residents declined by $1.4 billion USD.
Odd.
So, yeah, it suggests that despite the headline reserve improvement, there's this simultaneous significant shift away from those FX-protected deposits and a reduction in foreign currency deposits themselves. It could signal maybe weakening confidence in the KKM scheme or perhaps just a general move away from holding FX.
Right, so not quite as straightforward as just reserves are up.
Yeah.
Let's talk about the debt, because those numbers are quite striking. Private sector external debt climbed to a staggering $190.4 billion USD in May. That's an increase of $18.1 billion USD just since the end of 2024. That feels like a really significant jump in a short period.
It is a big jump, and it definitely raises an important question about short-term risk. Of this private sector debt, $57.8 billion USD has a maturity of less than 1 year. That's money due relatively soon. Banks are holding the largest share of that short-term private debt, about $38.1 billion USD. Interestingly, though, the overall short-term external debt across all sectors, public and private, did see a slight decrease in May, down to $222.3 billion USD.
Okay, so private short-term is up, but overall short-term is slightly down. Does that mean the risk is balanced, or could that slight overall decrease be masking vulnerabilities? Maybe. Does the Net International Investment Position, the NIIP, give us a clearer view?
The NIP, yeah, that gives us the broader context. And it's not great news, frankly. It deteriorated by another $9.2 billion in May, reaching NINIC of $309.0 billion USD. What this means, basically, is that Turkey's liabilities to the rest of the world, what it owes, significantly outweigh its assets abroad. It's a crucial measure of the country's net financial health relative to the world, and this continued deterioration indicates a worsening position. It reflects that accumulated debt and the widening gap.
That's a significant negative balance. And how are investors reacting to all this? Because I saw some data that seemed almost contradictory.
Yeah, the investor behavior is fascinating right now. It really tells a story of divided sentiment. On one hand, foreign investors were net sellers of Turkish government bonds, the DBS, by a massive $493 million USD in the week of July 11.
Wow, nearly $500 million out of government debt in a week.
Exactly. That's a huge outflow, signaling, maybe a lack of confidence in sovereign credit or perhaps concerns about inflation or the currency. But then, surprisingly, in the very same period, those same foreign investors were net buyers of Turkish stocks to the tune of $178 million USD.
Selling government debt but buying company shares.
Precisely. It suggests a kind of selective optimism, maybe? They might be wary of Turkey's government debt profile, but they're still finding value, or perhaps speculative opportunities in specific Turkish companies.
Interesting. And what about domestic investors?
Domestically, the picture's also a bit mixed, but leans towards stocks and funds. The actual number of stock market investors dipped slightly, down to 6.43 million. But the total value of their investments actually increased, hitting 15.19 trillion Turkish lira. And participation in investment funds continued to rise as well.
So fewer individual players maybe, but more money overall going into stocks and funds domestically, perhaps seeking refuge from inflation.
That's a very likely driver, yeah. With high inflation, holding cash is unattractive and other traditional options might be limited, pushing more money towards the stock market and investment funds.
Right. Okay, let's turn now to an area that impacts everyone directly. The housing market. We're seeing what you called a surprising shift here, especially when it comes to what properties are actually worth.
That's right. It's quite a divergence. So nominally, housing prices increased by 32.8% year on year in June, which sounds like a big jump on its face, right?
Yeah, over 30%.
But when you adjust for inflation, looking at it in real terms, prices actually decreased by 1.7%. So those nominal price increases aren't even keeping pace with inflation. For homeowners, the real value of their property is actually eroding slightly.
That's a really important distinction. Prices up, but value down in real terms.
What about the number of sales? And specifically, are foreigners still buying?
Well, total housing sales in June were actually quite strong. We saw 108,000 units sold monthly, which annualizes to about 1.62 million, so activity is there. However, sales to foreigners dropped significantly, only 1,600 units in June. That makes up just 1.5% of total sales, which is quite low historically.
So a real cooling off in foreign demand for Turkish property.
Seems that way, yeah. Could be due to changing regulations, the economic climate, maybe currency issues, or a combination.
And then there's the rent situation. You mentioned a divergence between sale prices and rental prices. Exactly. It's a fascinating split. Despite that real decline in housing sale prices, average rental prices per square meter have seen sharp increases. This is particularly noticeable in Turkey's western provinces, the ones receiving net internal migration, according to the 2024 stats.
So people moving within Turkey are pushing up rents in certain areas, even as buying becomes less valuable in real terms.
That's precisely the picture. It shows this clear split. Buying real estate might be losing real value, but the demand for rentals, especially fueled by internal migration patterns, is really pushing up prices in those key destination areas.
Interesting dynamic. Okay, but on a more positive note for internal demand generally, what about consumer spending? Are people still spending money?
Yes, the latest card spending figures offer some comfort there. Card spending continued its strong increasing trend right through the first half of 2025. That suggests pretty robust domestic consumption is holding up, which is a key indicator, right? It suggests internal demand remains relatively healthy, providing at least some cushion against these other economic headwinds we've discussed.
Good to have some positive signals in the mix. Okay, finally, let's just zoom out briefly to the global economic landscape. It always provides crucial context for what's happening domestically in any country, Turkey included. What are the key global takeaways from the past week or so?
Well, looking at the key global data points, we're still seeing persistent inflation pressures, especially in the US and UK. US annual CPI came in at 2.7%, UK at 3.6%, both a bit above expectations. The euro area was more in line at 2.0%. But this global inflationary environment could mean international interest rates stay higher for longer, which has knock-on effects.
Right.
On the growth front, the US is showing, maybe surprisingly, some resilience. Retail sales were up 0.6% better than expected, and manufacturing sentiment also improved quite a bit. That's potentially a positive sign for global demand. China's Q2 GDP, meanwhile, landed at 5.2%. That's stable, in line with forecasts, but it is below the pace of the previous quarter, so maybe some moderation there.
And commodities, oil, shipping costs.
Yeah, U.S. crude oil inventories decreased, which could nudge oil prices upwards. Not great news for energy importers like Turkey. And the Baltic Dry Index, a key measure of shipping costs, rose to 2,052. Higher shipping costs can also feed into inflation.
Okay, so putting all that together, sticky inflation globally, some U.S. resilience, but maybe China slowing rising commodity costs. What does this mean for Turkey?
Well, placing Turkey's situation in that broader context, the global data, especially from the U.S. and China, it continues to signal a period of what you might call direction seeking. There's ongoing volatility, uncertainty about where the major global economies are truly headed. And this external environment with its question marks around inflation, interest rates, commodity prices, global demand, it just adds another significant layer of complexity, another set of headwinds, really, to Turkey's existing domestic economic challenges and opportunities.
So a complex domestic picture meeting a volatile global one. As we wrap up this deep dive then, hopefully you listening have gained a more comprehensive understanding of Turkey's really complex economic situation. We've touched on the struggles and those surprising nuances in manufacturing, the significant weight of external debt, that mixed picture around central bank reserves, and the quite dynamic shifts in the housing market.
Absolutely. And I think it's important to remember knowledge like this is most valuable when it's really understood and applied. These numbers, they show this mix of serious challenges, but also some maybe unexpected areas of resilience or shifts that definitely bear watching closely. It's this complex tapestry of numbers, isn't it? It's not just data points. It's like different parts of an engine reacting differently under stress. And it offers clues, potentially, to where the economy might be headed next.
So, what does this all mean for you as you process these insights? It perhaps brings to mind a quote often attributed to Karl Marx. Holding on to production means holding on to power. Something to think about. What do these trends truly imply for the future? And what will you be watching next in the global economic landscape as it impacts Turkey and beyond? Definitely something to mull on until our next deep dive.